final section, which is businesses. So for our business owners who are still with us, thank you so much. And you've, I know that we're now going on to the hour-and-a-half mark. So, but this section shouldn't go for too long. So, and for those who are individuals and investors and decided that they don't need to hear this, thank you so much for joining us, and really appreciate you joining us this evening. And again, we'll be sending through the slideshows for your reference. So all that being said, let's keep moving forward. So with business owners, again, this is the same checklist, but if you download it, it's on the second page is the business section there, and it has a really handy checklist of things that you need to consider. Again, the good news is that if you're a Hannans client and we do your book work, then we'll be all over this, and we'll let you know, if you're good to do your tax, or if you haven't done things that you need to do to get your tax return lodged. So some of those things include just obviously making sure your bank accounts are reconciled, that you've checked your depreciation. So if you've gotten rid of any assets, so check your depreciation. If you've got, for instance, a computer that you claimed and that computer since died, then we might be able to just write off the full laptop. If you've traded in a vehicle and it's still sitting on your depreciation schedule, obviously we've got an issue, so we've got to recognise that that's no longer there. Home office usage and personal usage. So we talked about it a lot when we talked about personal tax deductions, but this is definitely very applicable for our business owners. So if you've got insurances, electricity, other things that you've got in terms of home office usage, it can be quite substantial. So we need to make sure that you're recording those personal deductions and that percentage, and we'll need that to complete your end of year tax return as well. And the big one is the motor vehicle. So all the things that we've talked about already. So making sure you've got your logbook and your opening and closing odometer readings as well. So again, you can check that statement, the checklist, and if you've got any questions, you know where we are, and just get in contact with us and we can run through that. Due dates, so already those important due dates that we talked about before. So for businesses, depending on what sort of structure you're in, you should have until about May next year, so May 2019, to get your tax return done. Now, that's when you have to lodge it. But we don't like for clients to leave it that long. Like I said, we'd like to have everyone wrapped up by March. Unfortunately, we still have the stragglers who come in and they give us their information in May or June, and they get a bit disappointed sometimes when we can't get the tax returns done straight away. But that's a peak time for us, so we're busy preparing for the next year. And obviously we like to have a fast turnaround with our clients, so we prefer for you to come in somewhere between even July and March, and that makes sure that we can get your tax return done efficiently. Ideally wait until after tax time unless it's urgent. Again, we like to focus on individuals during that time, but of course if you need your tax return done because you're waiting on a big refund or you need it for finance purposes, then certainly we're more than happy to have a look at it. But if you're not in a rush, ideally if you can wait until after October, that would be fantastic. Payment summary. So I know that some people here are employers, and sometimes some of you are employers for the first time, which is really exciting. But this is becomes a little bit of a stressful time for our bookkeeper, Gina, because we've got hundreds of clients that we assist, and a lot of those clients have payroll. So throughout that time, and she's already started now, start reconciling the wages and the superannuation, make sure everything's in order, and concentrating on getting those payment summaries out. Now, I must admit, if you use Xero, which 99% of our clients do, which is fantastic, Xero allows for you to email out the payment summaries. So with a click of a button, you can email it out to your employees, and then with another click of the button, you can submit that information to the ATO. So that previously used to be us manually handwriting out payment summaries, and some clients had tens, if not hundreds of employees, and so to write those out was just a bit ridiculous. So it's fantastic now that that's all automated, which is really, really good. That has to be out by the 14th. So if you're managing that and Hannans isn't doing that for you, then make sure that that goes out by the 14th. That's the due date there, and that's obviously making sure that employees can promptly then get their tax refund back as well. If you are unsure if we're doing it or if you're doing it, just get in contact with us. Most of the time, we'll just assume that we're doing it unless the client has previously done their own, or if you've communicated otherwise. In any case, we've got a very comprehensive list of all our clients that have employees, even if you're an employee of your own company. And so if you don't contact us before we do, we'll be in contact with you to make sure that you have everything in order by that time. Some of the things that we look at when we're looking at the wages reconciliation is that making sure your super's being calculated correctly. Again, with my Xero automating a lot of things, this doesn't seem to be an issue anymore. The reason why I had that fraudulent that slip and said Maya was because Maya it was manual, and so a lot of people unfortunately had some issues with super not calculating correctly and things like that. So yeah, so payment summaries. The other one is talking about super. Super has to be paid by the 28th day of the following month, so the 28th of July. Now, if you don't pay your super on time, you miss that as a tax deduction. So the ATO says that if you don't pay your super on time, we won't let you claim the tax deduction for it. So please be mindful of that. If you've fallen a bit behind in your super obligations, have a chat with us and we'll see how we can assist. If you lose 30% tax deduction on your super, that's quite a substantial amount. So just something to be mindful of. TPAR reports. Now, some of you probably are wondering what that is, and that's something that's probably come in place the last 2 or 3 years, and it's only applicable currently for those who are in the construction industry, generally, or trade industries. So what the TPAR report is, a taxable payments annual report, and effectively it's like a payment summary but for businesses. And it's to stop the black economy, so the cash economy. So a lot of builders and labourers and carpenters and all those people who were doing the work, producing an ABM, but then they weren't claiming on the tax return. So now it comes through the pre-fill that we download. So we get a download and we can actually see that information. So almost like a payment summary for an employee. So if you're in that trade industry, you need to make sure that you have that. Likewise, if you're doing work for other people, note that information will be recorded on your pre-fill with the ATO. And we talked about tax return due date. So you do have roughly until May. It depends. If you haven't been lodging on time, you might only have until October. Please feel free to get in contact with us and let us know when you'd like your tax return to be lodged as well, particularly if you do want it to be lodged within the earlier months. Then we can start scheduling it in and making sure that we allow time for it. We will be in contact and we'll be sending an email out to request just a bit of a quick questionnaire with our clients to ask when you want your tax return done, so that it can help us with our scheduling. We have already scheduled the tax returns for next year, and pretty much it's just based on last year. So if you had your tax return done in December last year, then it will be scheduled again in December this year, unless the client, or unless you've already indicated to us that you would like it done sooner or later. And one thing that I would like to highlight is that just because we've prepped your tax return doesn't mean that you need to pay it. I say that because I prefer to get tax returns done sooner rather than later, so we know up front what the client's obligations are. And so if you do have an amount payable, that we don't get a shock and a surprise come May, and then all of a sudden you're stressing about paying for it, and then you've got to pay that bill plus the current bill, and it just becomes a bit overwhelming, I guess, for clients. So now most of our clients, if not all of our clients, we've done tax planning for, so we've already anticipated how much tax you have to pay. So it shouldn't be a surprise to you, but even still, often I'd like to get the tax returns done sooner rather than later. It's also good for finance as well. So if people are going for finance, then we're not stressing out the last minute going, can I get my tax return lodged yesterday because I'm going for a home loan or a new vehicle. Again, it's always just good to get it out of the way. Cool. All right. Now this is the fun bit, and possibly the reason why a lot of you have joined the webinar, because I know I sent a few links out when I was doing the tax planning. So tips to minimise your tax. So these tips include accruals, so what you can take up. So for those who don't know what accruals is effectively when you put a journal entry into your accounting system. And accruals means that you've incurred that expense, but you haven't yet paid it. So let me use an example. I get my electricity bill every quarter, but I haven't received my one before the end of financial year. I know that it would roughly be about $500 worth of electricity that I would have incurred to this point. Then you can take up a journal entry, which, you know, obviously we would assist you in doing, to recognise a portion of that expense that hasn't gone into your accounts because you haven't physically paid for it. So so this can be really good, I guess, again, because if you've got expenses that you know are coming up in the current year that you haven't yet received an invoice for, or that you haven't yet paid, then we can put an adjustment in the account. $20,000 immediate write-off. The trick with this one here is that we've had quite a number of clients who've had a new office fit out or a new shop fit out. You can't claim it on fixtures. So if you put walls in, flooring down and things like that, that's classed as a fixture and has to be depreciated over a long period of time, 40 years in fact, which I think is crazy, because if it's a rental property, one would argue you're not going to be there for 40 years, but unfortunately that's the time frame that the ATO allows us to claim, or over the lifetime of the asset. But if you've got plant and equipment, so cars, computers, new printers, tools of trade, things like that, then you'll be able to claim that immediate write-off. The other thing that I would highlight is some people think, like I've got some clients who've gone and bought really big machinery, and they've got the supply to invoice the machinery in components. So they might, let's say they've bought a new bobcat or a skid steer or something like that, and they've got that item, and then they've got the buckets that attach to that machinery. Then they'll try to get two separate invoices, but then one would argue that you can't use the bucket by itself. So really you have to consider them together, and then that bumps it over the 20,000. So please be mindful of that, because some people try to be a bit tricky about things, but unfortunately I use a bit of, if it's sounds too good to be true, then it generally is, unfortunately. So just be mindful of that. When in doubt, just ask us and we can question and query those things for you. Okay, so the next one here is prepayments. So now I have it in the next section with regards to how are you accounting. Are you accounting for cash or accruals base? If you, like I've got some clients that, for instance, have raised $80,000 worth of invoices and they haven't yet been paid, it might be best for us to do your tax based on a cash basis. I've got one client where it's about a $40,000 difference. So it's the difference between them paying an extra $12,000 and saving that $12,000 just by strictly switching between accruals and a cash basis. So this is really important. So it depends on the type of business that you are. So if it's, for example, a hairdresser, and you always collect your payments via cash, and there's no difference between your accruals when you raise and collect your money compared to when you receive it in cash, then it doesn't matter if you're on cash or accruals. But if you do know that you've got quite a number of outstanding invoices and things like that, it might be best to go on a cash basis. That being said, if we've lodged your tax return previously on an accruals basis, we'd have to do adjustments, and you have to meet certain criteria to be on a cash basis. But again, if this is you, or you think there could be something there, then please get in contact with us and discuss with us, because like I said, we've had clients who've had significant, like tens and thousands of dollars in tax difference by switching between cash and accruals. The next one is writing off bad debt. So you don't want to pay tax on something that you've got sitting there in your accounts receivable that you know you're never going to receive. So make sure that you go through your outstanding items and write anything off that you need to. Wage bonus. Now this is actually something, again, I know that we've got a number of directors here who I think this is going to be applicable for. So if you've got, let's give me an example. So you're an employee of your own business and you've worked really hard and you've decided that you're entitled to a bonus, then you can actually take up an accrual. So this is if you're on an accrual basis, accrual for the bonus that you will receive. You have to pay it within 12 months. So when you're taking up that accrual, it has to be paid out within 12 months. but it is effectively a way for you to shift the timing of that expense and bring it forward. So rather than getting that deduction in 12 months' time, you can get it now, and then next year you'll obviously take up another accrual and bring it forward. So effectively you have this, sometimes it's accrual that you're always bringing forward, and it always, almost in some instances, becomes a permanent tax deduction, I guess, because you're bringing it forward all the time. So I hope I've explained that well enough. But this isn't all just applies to directors or business owners. It can apply to your staff members as well. So I know I've done this in many instances. So I might say to the staff, hey, you will get a 10% bonus at the end of financial year if you hit your targets. And we get to that point, and I know that some people have hit their targets. So I will take up a journal to recognise the expense that I have to pay within the next 12 months. That allows for me to bring my deduction forward. So definitely think about that. I think there are some people in the webinar tonight who that will be applicable for. So just have a think about that and see if there's some way or that would apply to you and how we can utilise that. And take up directors' loans for business to business for equipment and other. Take up directors' loans to the business for the equipment and other assets. So what I mean by that is, particularly if you've recently transitioned from a different structure to a company or even over to a trust. And I know I had a meeting with a client who is in exactly the same circumstance as this. So they've just gone from a sole trader over to a company. And she said, well, what do I do to recognise all the assets that I have paid for personally? And effectively what we do is we take up a journal to recognise the market value of those assets. So it might be, for instance, computers, chairs, vehicles. And let's say it totals a total of $50,000. We'll be able to recognise that $50,000 worth of assets and then offset it against the director's loan account. So what that means is that the business will now owe the director $50,000. What that means is that the director can draw down now $50,000 in repayments to repay them for the equipment that they gave to the company without having to pay tax on it. So there can be some strategies that we can incorporate there. Obviously, you have to have those assets that you need to put into the company, but definitely something to think about as well, especially for those who have transitioned from a sole trader to a company structure. If you've restructured, then that's going to be applicable for you. All right, so next one is defer income. So again, if you are on an accruals basis, this is easier to do. So just recommend to clients that if you've got, an invoice to raise, can it wait until, the 1st of July for you to raise that invoice rather than recognising it now? Can you recognise and date it the 1st of July? Now, this all sounds good in theory, but often your client wants the invoice dated the 30th of June because they want to claim it as a tax deduction. So sometimes we can't always get around those things. But for instance, I work for a company who their turnover was millions of dollars. We were able to defer about $1 million worth of sales, which saved the company about $300,000 in tax for that particular financial year, just by changing the date from the 30th of June to the 1st of July. So it was a very effective strategy, and $300,000 is obviously a lot of money to defer. So that was very effective in their circumstances. I find that for a lot of clients when I suggest that, they say I can't change the invoice date. So, but definitely something to think about. Bring forward your expenses as well. So I always say to people, if you've got a telephone bill, electricity, and it's due, why not pay it now, rather than wait till the new financial year, because then you're going to be able to get that tax deduction. Likewise, if you're thinking about buying a new vehicle or new equipment, consider buying it now if you're going to do it in the next few months anyway. Just consider pushing it slightly forward. I talked about accruals versus cash method already, so that's what that's about, just deciding on what's going to be the best way for you to record. Best way to recognise your wages as well. So this is a really big one, especially if I've got a client who has transitioned from, again, one structure to another. Had another meeting with a client, and she questioned whether or not she should pay herself wages, or director's fees, or dividends, or drawings. There's so many options when it comes to companies. I recommended to her in her circumstance that she shouldn't recognise any wages in the first year, but that's mostly because she's a brand new business and she's just getting off the ground and her income isn't consistent. And I said, let's just recognise it as a loan for now. Obviously, still try and keep some tax money aside, because if you recognise it as a loan, then you're not paying your tax throughout the year. And that just gave her a bit of breathing space as well. So she was able to hold on what would have otherwise been paid to the ATO, held on to that cash a little bit longer, giving her some breathing space and some cash flow. And as we all know, cash is king, and that's really the blood flow and the heartbeat of every small business is having that, or any business for that matter, is having that cash flow. Splitting income with your spouse and family members legally, of course. There are some ways that you can do it illegally. That's if you've got personal services income, i.e. if you're just trading your time for money. Like if you're a doctor, for example, you won't be able to split your income because your income is derived from your personal exertion. But if you sell products and services, if you've got a property that you rent, you're using tools of trade and things like that, and there are a number of other requirements, then that's not personal services income, and you're well within your right to I guess, share that income in various ways. It depends on your structure as to how you can do that. I could probably talk forever on the different mechanisms that you would utilize here. But what I guess I would instead highlight is consider if you've got a spouse who's got income less than yours. So if they're a low income earner, there might be an opportunity for you to recognise a dividends or a trust distribution over to them. Or maybe they're actually working within the business for free currently, and finally you can recognise the time that they're working and pay them a wage as well. So just have a think about that. If you've got a trust structure, you can distribute amounts to your children, even if they're minors. It's only $416, which isn't a lot. We've got some clients who've got 2, 3, 4 children, and that tends to add up. But just have a think about that. If you do have a trust structure, there might be children that we might be able to distribute some money to as well, and helps to minimise your tax. I mentioned this already. So pay your superannuation guarantee on time. So it's only tax deductible if you pay it on time. So that's a really important one. And the last one there is just super deduction. So if you are self-employed and you haven't been paying yourself super, or you have been but want to top it up, then just think about the super deduction. If you are earning over 37,000, then you're paying 34 cents in the dollar. Whereas within super, it's 15 cents in the dollar. So it's about a 19% tax savings by putting that money into superannuation. So I don't know about you, but if I was getting 19% on an investment as a return amount, I'd be very happy with that. Obviously, there's all sorts of risks, I guess, you need to consider with superannuation, in the extent that if you're, still young and 10, 20, 30 years away from super, then it's going to be locked away. You're not going to be able to access it. So you need to consider whether or not it's appropriate for you. If you're not sure, again, come talk to us and we can put you in the right direction. Otherwise, just consider superannuation as a possible way to reduce your tax payable. Cool. All right. So we're now on to the next section. We're getting closer to the end of it, and we've now touched on that 2-hour mark. So we just got a few more slideshows to go. Okay, so here we go. Things you need to do before end of tax year. So there's a couple of things which again is on that checklist, and we're going to be sending out a whole heap of emails to everyone. Not too many, we won't be spamming, but enough to just remind you of all the things that you need to do. So get your accounts in order. So if you haven't done yours, and to be honest, I was one of those people. I was doing my accounts today and realized I hadn't done it in a couple of weeks, which was very naughty of me. And so I made sure that I got things up to date so I could get a handle on what my tax was for the year, so I could do my own tax planning. Let us know when you want your tax done. So yeah, get in contact with us, and particularly if you want it urgently, please let us know so we can start to prepare and provision time for that as well. Due dates and deadlines, we've already talked about it. Just be aware of those things. I think some of our clients rely on us reminding them, which is fine, but still it's important that you're aware of those deadlines. Cash flow and your goals. This isn't so much tax related, but I always use the end of financial year to reset myself in terms of my business and, plan my year ahead. I recap on how my year went. I like to, look at how the year went compared to previous years, notice any growth or perhaps any decline. Maybe my expenses have gone through the roof, and just use that time to really reflect and set myself up for an awesome new financial year. So just really encourage yourself to do that. And remember that, yes, we do have to get all the numbers organized for tax purposes, but really the main importance, I feel, with consolidating your numbers is just getting an idea of how your business is performing. And that's really what it's about. So make sure you take that time to reflect, and feel free to get in contact with us as well. I love doing goal setting sessions with clients and cash flow modeling and business plans. It's one of my favorite sit downs with clients. So if you want to arrange a session like that and you're on an accounting package, by all means get in contact and we'll make a time. If you're not on an accounting package, definitely you can still come in, but obviously there'll be a fee involved there. And paying yourself a wage, what's the best way? So if you're not already paying yourself a wage, or if we haven't been in contact with you to let you know how we plan to do it this year, just feel free to get in contact with us and just question those things as well, because that's a really big one. Review your structure. I'm looking at the people that we've got in attendance tonight, but I know that this is recorded, so there might be some other people out there who might need to consider the structure that they've got. This is something that we're quite proactive with, because it can make such a considerable difference to your tax savings and even to your asset protection as well. So I'd like to think that we're pretty proactive with restructuring clients when it becomes appropriate for them. But definitely have a think about it and just to reflect on whether or not you're in the appropriate structure. If you're in a trust, who can you distribute to? That was kind of touching on what I talked about before, the family members that you can consider distributing to minimise tax payable. Dear Emily put a massive pile of trust minutes in front of me today and the other day. So trust minutes effectively is the minute and resolution to decide how the funds from your trust will be distributed. So we've already gone through that. She tells me we've got about 16 more to do, and then we're done and dusted for this financial year. So we've looked at those things already. So if we haven't already been in touch, or if you're not sure, you want clarity, then get in contact with us, please. Claim interest on your credit cards. Sometimes they get overlooked. If you've been using your personal credit card for your business, make sure that you pick up on the interest deductions there. Pay-as-you-go installments, how do they work it out? So I showed you that pay-as-you-go withholding calculator, so you can use that. But again, for most of you, if your clients already, we've already done your tax planning, worked out whether or not you're on track. And if you're not, or even if you're not a client of Hannans, then make sure you get in contact with your accountant, or use the pay-as-you-go withholding calculator, which can help you to calculate those numbers. And the other thing was the cash economy. I'm just highlighting that because I know that the ATO, they call it the black economy, and it's something that they've been really, really focused on the last couple of years, and they've put a lot of resources, millions of dollars, into really cracking down on that. I think some people would have already seen that they're forcing people to, or making a requirement to have FPOS facilities or credit card facilities, and potentially moving to things not being allowed to accept cash or cash only. And lastly, so single touch payroll. I actually did a Jack chat on this, single touch payroll and super amnesty. If you don't know what that's about, then go onto our YouTube channel, so Hannans Finance, if you search that in YouTube, or if you have a look at our Facebook page, I did a webinar on that. Not a webinar, sorry, a quick vlog on that. So that's something that's coming up. Recognising assets you put into the business, I already talked about that. So if you've transferred assets, making sure we're claiming that as a tax deduction. Especially if it's less than 20,000, we can immediately write it off if we haven't already, and that can make a big difference to your tax as well. Having the right accounting system. I said before that we, 99% of our clients are on Xero, which is fantastic. And then we've probably got about another 10 this month that I'm about to just transfer over who are new business clients. The reason why I say it's fantastic is because it's, for us, we can use it to do your tax. We can use it to produce your financial statements. We can real time jump onto your accounts and review those things. And ultimately it saves us time. And guess what? If it saves us time, it saves you money. So, allows us to do the best job possible at managing your accounts, and having that real time information means that we can provide you timely advice as well. So that's why I'm such a big fan of it, because it's really been a game changer for our practice in the way that we do business, which is fantastic. Sole traders, what to consider. Biggest thing there is that if you've got sole trader income and wages, then your sole trader income is going to be taxed at your marginal tax rate. So just be aware of that, and that income gets included on your individual tax return. So some people think that they need to do a separate tax return, but that's not the case. It just gets included in your individual tax return. So yeah, just be mindful of that. Companies, the big one there is that you can pay dividends out. I think the biggest issue that you need to be mindful of is if you've drawn money out of your company and haven't declared it as wages, then there's this thing called anti-avoidance measure. So the ATO doesn't like that because they think that you're avoiding paying tax as an individual. So you need to make sure that if you've done that you've repaid that loan back to the company within 12 months. Again, if you're a client of ours, it's something that we automatically look at. That's a really big flag for us, a big red flag that we make sure that we address and target. If you're not a client of ours, just make sure that you're looking at your loan account. So any loans that you owe back to the company, they need to be repaid in about roughly 12 months. So make sure that you address those things. And lastly, trust. So the big one right now is making sure you've got your trust minutes in order. Again, I already talked about the fact that we're already looking at this, but they need to be done before the 30th of June. This is something that came in place, I think, about 3-4 years ago. Previously we could just do it when we did your tax return, but now we've got to actually put it in place, which is why tax planning is so important, because already we now need to anticipate how much we're going to distribute to your beneficiaries. So that's a big one there. Again, if you've got family members that you think could be beneficiaries, have a think about it. You might even have parents that aren't on Centrelink because they're self-funded retirees, and they can take some extra income without any negative effects. Then we might be able to distribute some income to them as well. So just have a big think about that one. And that's it. We did it. So we went slightly over time. That was probably due to my technical issues. And we'll just go to any questions now, and then we'll look to wrap up. When we go to those questions, I just want to advise that for those some of those that have joined us tonight, you're not currently clients. If you want to get in contact with us, there's our details. We're more than happy to have a chat and see if we can assist you. And thank you so much for joining us. It was quite a big session. 2 hours of talking about tax, I think, for a lot of people can be a bit overwhelming. So I really appreciate those who've stuck it out for the full 2 hours, and really, really appreciate you joining us tonight, which has been fantastic. For those who are watching back the webinar because you weren't able to join us, thank you for taking the time to then access the webinar. Hopefully this has been really helpful. I really hope that we provided you tips and some big takeaways and things that you didn't already know. But yeah, we'll be sending out a feedback survey. So please let us know if there is something that was of particular interest for you. It lets us know if there's something that a lot of clients aren't aware of, and we can make sure that we spend a bit of time educating our clients in that particular area. There might have been something that you already knew, or something that you didn't find overly interesting. Again, I'm happy to accept constructive criticism as well. So I think that's it. So if you guys have any questions, please fire them at me. If not, again, thank you so much. And I hope everyone enjoys the State of Origin tomorrow. Go the Maroons. I'm going to be down the coast celebrating with some other financial advisors. So hope everyone enjoys the game. It's going to be an interesting one because we've got so many of our Maroons who are now injured and or retired or whatever it is. So I don't know. It sounds by at this rate our whole team are going to be rookies, but we'll see how we go. So hopefully we don't have any Blues supporters here. But anyway, yeah, so go the Maroons. And again, thanks everyone for joining us. So I'll hang around for a little bit for any questions. If not, good night everyone, and we'll talk to you soon. Thanks, Sonia. Your pleasure, and thanks for all the questions. I really appreciate it. It definitely makes it, lets me know that people are watching and listening. And again, it's hard when you're doing these because you don't have anyone responding to you. So I appreciate the interaction.